If you work for a company, organization, or government entity that offers a retirement plan, like a 401k, 403b, or 457, it's an excellent way to invest for the future and reduce your taxes. In addition to regularly contributing a portion of your paycheck, you may even get extra money from your employer through a match. This podcast will review how retirement plan matching works, ways to maximize it, and what to do if you don't have a retirement account at work or you don't have matching available from your employer. Welcome back, everyone, and thanks for joining me. I'm Laura Adams, an award-winning author, financial spokesperson, a money speaker, founder of the Money Stack newsletter, and host of the Money Girl podcast with 43 million downloads. If you're new to the show, welcome. I'm really happy that you're here. We've got a wonderful community. And if you're enjoying the show or you're using it to up-level your finances, I'd love to get your rating or review in the podcast app of your choice, like Apple Podcasts. And if you have a question you'd like me to cover, I always love hearing your questions or your comments. I can answer it on our Friday Q&A show. You can call 302-364-0308 and leave me a voice message there, or you can always just write out an email using my contact page at lauradadams.com. And while you're there, be sure to sign up for The Money Stack. That's my newsletter that goes out 3 to 4 times a month, and it's filled with money tips, news, advice, tools, Q&As, and all kinds of good stuff that I'm into. So I would love to see you on the list. All right, so let's talk about 401k matching, and it could also be 403b matching or 457 matching. I'm kind of just using 401k in general for a retirement plan that offers this benefit. And a match is when an employer contributes to your retirement plan based on how much you put in. While employers that offer a retirement plan are not required to pay matching funds, a majority do, like 85% of employers do offer a match because it's a really valuable benefit and it likely helps them attract and retain good employees. I think retirement plan matching can also encourage employees to participate in a retirement account. And that allows you to maximize those additional funds from your employer and invest more money for a secure future. So let's talk about the contribution limits when it comes to using a retirement plan at work. No matter what type of retirement account we're talking about, there are always annual limits to how much you can contribute. For 2024, you can put up to $23,000 into most workplace retirement plans. And if you're over 50, you can make an additional contribution called a catch-up contribution. That is $7,500. So that gives you a total contribution of $30,500 if you're over 50. But the good news is that employer matching does not count against the employee's annual limit. So you can actually have more in your account than those limits that I just mentioned if you're also getting a match from your employer. So for 2024, the total pre-tax and after-tax contributions that can come from you and your employer are up to 100% of your salary, or $69,000, or if you're over 50, it's up to $76,500. So you can see there's a lot of room there for additional contributions that can come from your employer before you meet that annual threshold. So how does 401k matching work? Well, when an employer sets up their retirement plan, they can customize a lot of features of the plan, and that includes the match. So they might choose to offer no matching funds, or they could offer a very generous match. It is really going to vary depending on your employer. Employers can also contribute to your retirement plan regardless of how much you contribute. For example, your employer may have a profit-sharing plan that pays you quarterly or annually based on the company's performance, and that may not have any tie to what you put in as the employee. But when we're talking about matching, it's always going to be based on what you put in, the amount that comes from your paycheck into your retirement plan. So I want to give you some examples of how matching works. We'll take you through the math. And companies usually choose to pay either a partial or a full retirement match. With a partial match, your employer matches a portion of the amount that you put into your account up to a limit. So here's an example. It could be receiving 50% of your contributions up to 6% of your salary. So for round numbers, let's just say you earn $100,000 annually. 6% of your salary is $6,000. So the match means if you contribute at least $6,000 over the year, your employer will match 50%, or that's $3,000 on your behalf. So if you earn $100,000, you put in $6,000, your employer is saying, we're going to put in 50% of that, or $3,000. So you would have put in $6,000, the employer would have put in $3,000, you would have a total of $9,000 for the year. And that would be the minimum amount to max out the match, to get the most out of it. And of course, you could contribute a whole lot more than 6%. If you contribute more, such as 10% or $10,000 over the year, your employer would only match half of 6% of your salary, or $3,000. So $3,000 in that situation would be your maximum match. And even if you max out a 401k for 2024 by contributing $23,000, the most employer matching you would receive is $3,000. So you would have a total contribution of $26,000 if you're under 50 and you do contribute $23,000 and you get that $3,000 match from your employer, you would have a total contribution for the year of $26,000. And another type of matching is full employer matching. This is when your employer matches 100% of your retirement contributions up to a limit. And it's also called dollar for dollar matching. For instance, a full matching example would be receiving 100% up to 4% of your salary. So again, if you're earning $100,000, your maximum match would be 4% or $4,000. But if you only contribute 2% or $2,000 annually, your employer would only put in $2,000. So in that full matching example where it's 4% of your salary, you would have to contribute 4% to max out the match. But if you put in anything above that, the maximum that you could get is going to hold steady at $4,000. Now, some employers actually use a combination of partial and full matching. So the math gets a little more complicated here. For example, your employer could match 100% up to 3% of your salary. Then they could match 50% up to another 2% of your salary. So in that combo scenario, you would max out the match if you earn $100,000 and you contribute 5% or $5,000. You would receive a match of $3,000 on the first 3% of your salary, but you would only get 50% of the next $2,000, which would be a $1,000 match. So it would be $3,000 plus $1,000 for a total match of $4,000. Any contributions you make above 5% of your salary would not be matched. So in this situation where you're getting $100,000 and you have this combo, the maximum match would be $4,000. So you need to understand what is the math for my match and what is the maximum amount I can get, and really make sure you are putting in enough to get that maximum match. No matter the formula the company uses, the takeaway here is to always contribute enough to get the highest possible contribution from your employer. Otherwise, you're just turning down money, free money that could be growing in your retirement plan instead. Since matching contributions are free money, they give you an immediate return on your investment. So if you receive dollar for dollar matching from an employer, you actually double your money as soon as you contribute to the plan. And that doesn't even account for the growth those matching funds may obtain through your chosen investments inside the retirement plan. But the matching amounts are typically, fairly low. So to reach your retirement goals, you will likely need to contribute more than what is necessary to max out any matching funds. A good rule of thumb is to invest at least 10 to 15% of your gross income. For instance, if you receive a full match of 4% from your employer, ideally you would contribute 11%, and then added together, that would get you to a 15% contribution target. Now, if your employer offers an after-tax Roth retirement option, and most companies do, the annual contribution limits are the same as those of a traditional pre-tax account, and your company can match your Roth contributions just like with a traditional retirement plan. However, the matching funds that come from your employer typically get deposited into a separate traditional account instead of your Roth account. They're generally paid to you in a traditional account because that's pre-tax. So that means you will not have to pay any income taxes on the matching contributions you receive from your employer. I want to point out that there is new legislation in the Secure Act that actually allows for post-tax or Roth matching contributions. However, it's up to the employer whether to offer them. In a lot of cases, employers are keeping them in traditional accounts because those funds may come with a vesting schedule. And so if they were to give you an after-tax contribution for matching, that amount would be taxable to you. And in some cases, maybe you don't stay with the employer long enough for those funds to be vested, so that could get a little complicated. So let me explain 401k vesting. Many retirement plans come with a vesting schedule. This applies to funds from your employer, like matching and any profit sharing you may qualify for. So that means you have to stay employed for a set period of time before you own those contributions. Now, you're always 100% vested in your own contributions. The money that you put in from your paycheck, you always own 100%. But the vesting is going to apply for the matching portion or the profit sharing. For example, you might have a 5-year vesting schedule that happens gradually, such as owning 20% after 1 year, 40% after 2 years, 60% after 3 years, 80% after 4 years, and 100% after 5 years. So in this scenario, if you received $3,000 in matching in your first year of employment, and then you got terminated or you decided to leave at the beginning of year 2, you would only own 20% of that matched amount, or $600, and you would forfeit the remaining $2,400 to your employer. That would be the unvested portion. But staying employed for 5 years means you would own 100% of any employer contributions that were made to your retirement plan over those 5 years and, going forward. There's another type of vesting called cliff vesting, like falling off a cliff. This is a type where you own employer funds at once on a specified date. It could be after 3 full years of employment. So if you leave the company before then, you would own none of your employer's contribution to your retirement plan. But as long as you stay 3 full years, you would own all of it 100%. So you want to check your plan's rules before deciding to change jobs and really understanding, what would I forfeit, or, is it worthwhile to stay a little longer to be fully vested? Another rule is that highly compensated employees may not be eligible for complete employer matching. The IRS defines them as owning over 5% of a company or making over an annual income threshold for the prior year. And for last year, 2023, the highly compensated employee threshold was $155,000. You may only qualify for part of the employer match if you earned over that threshold. So again, this is going to come down to the rules that your company sets for your plan. You need to be familiar with what's allowed at your company. If you don't receive 401k matching, it's still wise to use your retirement plan at work. It is still a good idea to contribute at least 15% of your gross income. And if you don't have a workplace retirement plan, I would consider investing through an individual retirement account, or IRA, or a self-employed retirement plan if you have full or part-time business income. Remember that if you're fortunate enough to receive matching funds at work, it is an excellent benefit. It is a terrific way to boost your savings, reduce taxes, and achieve your retirement goals faster. That's all for now. I'll talk to you soon. Until then, here's to living a richer life. Money Girl is a quick and dirty tips podcast, and I want to thank our fantastic team. The show is audio engineered by Steve Rickyberg. Our director of podcasts is Brandon Gachus. Our digital operations specialist is Holly Hutchins. Our advertising operations specialist is Morgan Christensen. And our marketing and publicity associate is Davina Tomlin.